Good afternoon, everyone, and thank you for joining us today. I'm Derek McPherson, Vice President and Equity Research Analyst at Red Cloud Securities. Today I have with me on the call our webinar Mike Jones, President and CEO of Platinum Group Metals. Today's webinar focuses on Platinum Group Metals, who are developing the next major palladium mine. Palladium was one of the hottest commodities ahead of this COVID-19 pandemic, and based on what we see on the supply and demand fundamentals, it is going to be once we come out of it. So now is a good time to be sharpening your pencils on Platinum Group Metals, and a good day for today's webinar. The format for today, Mike will provide an overview and an update on Platinum Group Metals and where they're at, and then we'll take questions live from the audience, and we'll go through as many questions as we can handle in the time period. Just to I'll get the disclosures out of the way first. For Platinum Group Metals, there may be some forward-looking statements made on this call. I would direct listeners to the cautionary note on page 2 of Platinum Group Metals' corporate presentation, located on the company's website. For Red Cloud Securities, I would highlight that this webinar is for information purposes only and should not be considered a solicitation to buy or sell securities, or a recommendation to purchase or sell securities. And we note that this call does not take into account the particular situation or needs of individual investors. Participants should rely on their own investigations and seek their own professional advice before investment. Please see our most recent research on Platinum Group Metals located on our website for the company-specific disclosures. With that out of the way, I'm going to turn it over to Mike and give you the update on Platinum Group Metals, and I think we're going to be starting with a video. Josh?
Yeah, thanks very much, Derek, and thanks for everybody attending. So this video is going to go fairly quickly. I'll just use it as a way of giving a quick overview and an introduction to the company. So we're listed in both New York and Toronto. We're advancing the next great palladium mine. It is palladium dominant. It's located in South Africa, in the northeast part of the country. We're in what's called the North Limb, next to Anglo's Mogalakwena mine, the most profitable platinum mine in the world, and palladium. Also next to Ivanhoe. The project is part of a very large land position, about 800 square kilometers, and we're connecting a series of wells together with the project for the water supply that have been drilled and tested. The power connects to the main grid 70 kilometers to the south as part of the construction and the feasibility study. The deposit's been very well drilled. It's 13 kilometers long. The feasibility study design has a central concentrating facility and 3 mining areas. The central and the southern areas are mined first, and then the northern area is picked up about 25 years later. It's a massive deposit. It's accessible 140 meters from surface by decline. So importantly, no vertical shafts, and it's bulk mineable. So this 8-kilometer long reserve is about 187 million tons and contains 19.5 million ounces of reserves. Palladium dominant, 63% palladium. The zones are mined by a bulk mining method. So effectively, you're using machines rather than the handheld method. You're able to drill large fans and effectively put in a slot and then drop a 13-story office building with each slice here. So the main levels are 40 meters apart. The ore is conveyed to surface rather than taking the surface with trucks and sent to a standard concentrating plant in the middle. That concentrating plant produces a flotation concentrate, and it's a standard plant right off the South African playbook. DRA, our processing engineer, has built actually about 100 of these plants. We also produce backfill, which we put back underground, and this reduces the area. Concentrate is shipped out by truck to the smelter. Impala, our partner, owns a large smelter and has a first right of refusal on that study. And just for a sense of scale here, this is quite a serious feasibility study. So we've invested about $72 million into the project so far, about $50 million worth of drilling, and $22 million worth of engineering. So the feasibility study that we're going to talk about is 140 professionals for 2 years to build this mine plan up. So we've talked about the standard disclaimer slides and disclosure. We're both listed in Canada and the US, so a certain cautionary note to US investors. We'll use the Canadian terms, and obviously the standard caution on forward-looking statements, particularly in the uncertain times we live. There's 2 parts to the company: the Waterberg joint venture, which we just looked at, And we have a second part of the company. We don't get a lot of attention for this yet, but we're very excited about it. We have a joint venture with Anglo American working on batteries that would use PGMs in a lithium battery. And this is relatively early stage work, but it was exciting enough that Anglo American, a $30 billion company, issued their own press release about forming this company jointly with us. But the main asset is the 19.5 million ounces of reserves, not just resources, reserves in our palladium dominant deposit. And the feasibility study has a 45-year mine life. We're right at a critical point now where we expect the mining right to be granted, and that will trigger a construction decision and a potential investment all at Impala's cost into the project. We have a very compelling valuation. We're sitting in a market cap of about $80 million. Just for comparison, our share after Impala's exercise of their option, our share of cash flow at current prices in the feasibility study model would be $100 million a year plus annually with a 45-year mine life. Pretty incredible numbers in a definitive feasibility study model. That's attracted some pretty senior investors, including HCI, which is a South African fund. They're actually fully empowered as well under the local legislation, but they're a fund that owns hotels, casinos, bus companies, shipping companies, coal mines, all kinds of things. They've been a great supportive shareholder. Franklin Templeton in California, Liberty in Boston have been very supportive shareholders here. At the asset level, you have Hanwha and Jogmec in the Japanese consortium, and you have Impala. Palladium remains amazingly strong, but it's backed by the fundamentals, and we'll talk about that in a second. Why should you be interested in the stock right now? It's because of the milestones that are in front of us and the potential recovery, as was mentioned earlier, in palladium. So we expect our mining right in the second quarter of 2020, and we expect Impala to make a decision on construction and their option in Q3 2020. Because it's a decline accessible mine, it can be developed quite quickly, and first production would be in the start of 2024. What's different about Waterberg is that it's thick. So a conventional platinum mine is just 1 meter thick, mined by hand. And about 70% of the world's platinum production comes from South Africa, and the majority of that is from a 1 meter thick layer. In this deposit, we have a 40-meter stope height, so we're mining literally a 13-story office building at a time, as we mentioned earlier. The deposit's 140 meters from surface, so we can access it with a short development rate or time and a low cost. And the concentrate we produce, and this is really important, evaluating any PGM project, you have to look at what concentrate you produce and where could that concentrate be smelted and refined. If you don't have a way to get the metal to market, it's just not going to work. And the quality of the concentrate you produce is extremely important. And that's one of the reasons that we've been picked by Impala for investment, is the quality of the concentrate. As I mentioned, we're on the north limb. Many of you might know of Ivanhoe's project, where they're sinking a vertical shaft. They've invested some $500 million there. And just north of Ivanhoe's project is the Mogalakwena mine. It is a monster. It's also bulk mineable open pit, and it's scheduled to produce about 1 million ounces a year with at least $1,000 an ounce margin. So we know that a lot of people have trepidation about investing in South Africa because of the country's reputation. Here's an example of a bulk mineable PGM mine that will probably make something like $1 billion a year. So not necessarily a terrible place to invest. This is a cost curve and where Waterberg sits on that cost curve. This is developed by Metal Focus. They're an independent research organization. It's included in our feasibility study. It shows that Waterberg is right next to Anglo's Mogalakwena mine, which is the yellow on this bar chart. The top right-hand part of this chart are the conventional platinum mines that are 1 meter thick. We're looking at the cost of producing a 4E ounce, so platinum, palladium, rhodium, and gold together. Interestingly, this chart ignores the fact that our ounces are actually worth more because they're higher in palladium. This is just looking at the 4E cost curve with an all-in sustaining cost of $767. And we'll talk about what the basket of those ounces are worth today in a minute. But the productivities are staggering here. And this is why mechanized mining is the future, is the conventional platinum mines are producing 2 to 3 ounces per employee per month. That compares to the Mahalaquina mine of Anglo's at the other end of the curve at 40 ounces per man per month, and at Waterberg at 30 ounces per man per month. So it's really just chalk and cheese, to be frank. Our partner Impala recently bought North American Palladium. Many of you will know this. They paid $758 million in cash. Why did they do that? Because they saw with great confidence what the palladium market looks like. And even with the current crisis in the world, they still made an amazing deal here. But the head-to-head comparison between North American Palladium bought for $750 million and Waterberg is staggering. So on tons in the resource, 72 million versus 242 million. The reserve size, 3.5 million ounces at North American Palladium, 19.5 million ounces at Waterberg. The grade is higher. The cost of production is lower in our feasibility study. And you're talking about 420,000 ounces a year versus 294,000 ounces a year. Built out, fair to say, they paid $216 an ounce of reserve. We're currently trading, owning 50% of the project at $8 an ounce. There's a bit of a disconnect here. What's Impala's view of the project? This is from their own annual report. We counted, they listed Waterberg 22 times in their most recent annual report, and they listed as the potential lowest cost mine in their portfolio. So for you as an investor, this is a very good indicator of where the project is going forward. A couple of comments about the palladium market in general. So obviously we're in a very uncertain time in the world with a lot of changes. You know, interestingly, the global auto market has effectively shut down, but there are early signs of the auto market coming back. We were on a conference call with a group in Singapore and in Beijing in the last 2 days, and they're definitely talking about the Asian market coming back online very quickly. The auto market consumed 9.6 million ounces of palladium in 2019, or 84% of the market. So for palladium, it very much is about autocatalysis. The South African government just ordered a 3-week shutdown. We're in the middle of that right now. And South Africa represents about 38% of the world's palladium production. So we will see a pullback of production, and we were in an extreme deficit position. So in 2019, we saw a 1.1 million ounce deficit. And we expect this deficit to still be very much intact going forward, given that you saw auto demand and production also step off. And this has been reflected really in the price, with palladium maintaining through the crisis now a better than $2,000 an ounce price. This is what our basket price has done over history. So you're looking at 63% palladium, 29% platinum. Sadly, only 1.5% rhodium. We wish we had more rhodium. But this is what the basket price has done since our pre-feasibility study. So you can see April 2nd, that's just about current with today. You're looking at $1,800 a basket ounce versus a cash cost of $640 an ounce in the feasibility study, and an all-in sustaining cost of $767. So this project, because of its profile, has attracted some great strategic investors, as we've talked about. And the highlights of the numbers from that feasibility study, which was approved by all the partners, including Impala, are 19.5 million ounces of reserves, 420,000 ounces a year, as we've discussed. The feasibility study was done on the mining side by Stantec, which is a very senior global mining engineer, done the mine designs at Grasberg, at Otogoy, at all of the big bulk mining underground mines really in the globe the senior ones have been done by Stantec. They did our design, and DRA did our plant which is the most experienced PGM plant designer and EPCM engineer in the world. The value, pretty straightforward. Today, we own 50% of the project, and at today's spot prices, the NPV 8% discount rate after tax is $1.5 billion. And the estimated peak funding is $617 million. And I'll talk about the steps going forward from construction decision to funding in a second. At 20% up prices where we are now, you're looking at about a 27% IRR, which with a 45-year mine life classifies this as a truly world-class deposit. First production from underground 2023 and first concentrate sales in 2024. The immediate milestone, though, that I think will be very important for the stock is our mining right, which we expect as soon as South Africa comes out of its current lockdown, which is expected to happen on April 17th. Very soon after that, we should see our mining right granted. The current ownership structure is we have an effective interest of 50.02 directly and indirectly. We're the manager of the project, the majority owner. Impala bought 15% for $30 million in cash, and they have an option to increase their stake. If they do increase their stake, the ownership percentages look like this, them at 50.01 and us at 32% effective. They would become the operator, but in order to do that, they have to do three things. So they have to, first of all, and they all have to be done, not just one of them. So the first thing they do is they buy 12.1% from JOGMEC for $34.8 million in cash. And JOGMEC's role here is really to facilitate business and make sure that the metal goes back to Japan. And in exchange for that purchase right of their points, Impala agreed that all of the refined metal from Waterberg will go back to Japan. So this is a globally strategic asset, and that's why that happened. Secondly, Impala has to put up $130 million as a one-step firm commitment. And finally, they are to specify the project finance terms for the construction for all of the partners. We recently just amended their option agreement to give them 90 days after the mining right. The mining right has been a little bit slow in coming, but this gives them the flexibility they need to make that formal construction decision. But in consideration of that, Impala agreed to pick up 100% of a 55 million rand budget. So most of our staff actually in South Africa are now working on Impala's program, and that's an implementation project budget to both optimize the project, look and mitigate at any ramp-up risks, and to prepare for operational readiness. In the feasibility study, there were a number of things that we had to do to be ready to start to construct our declines, and that's part of that program, and they're also looking at optimizing and preparing for construction. This is at the 3-year trailing average prices, NPV just under $1 billion. On this chart, the green is the revenue side, the light green is the base metal credit, the orange and red colors are the costs, the bright red is the capital cost with peak funding at 600 million. Internally, we're using a 50-50 debt equity ratio, although that's not fixed. And the net to us, net of Impala's earn-in, assuming that they exercise their option, the net under the feasibility study model at a 50-50 debt equity would be about a $60 million call to us, which given our shareholders is very manageable. And as I mentioned, the proven and probable reserves are a 45-year mine life. At the 3-year trailing average prices, which is very low, the project would generate about $210 million of positive cash flow a year. And at current prices, we're looking at about $300 million a year positive cash flow after tax. So that program that's going on now, it involves geotechnical work around the box cuts and the declines. Again, work that you would do normally to prepare for a tender to go out to construction. First things on the critical path, to look at the decline path as well and ensure that you understand that geotechnically ready for a tender. They're doing detailed simulations to optimize the upper levels of the mine, which are critical to the ramp up. We're looking at a couple of opportunities. One is dry stacking of tailings, which would have some additional operating costs on the tailing side, but could save a lot of water and cost savings there. Impala has a standard housing program that they run for their other mines. They have about 40,000 employees, and they're looking at integrating that with the operational readiness plan for Waterberg. We think we have sufficient money in the program for that. It's just the mechanism of how that would be done. And then further execution and operational readiness. So making sure that our training program is lined up, that our underground skills for mechanized mining can be well prepared, and to look at potential contractors to accelerate the initial decline drive. The other thing, of course, is tunnel boring machines as a potential way to accelerate early development, and the use of battery underground equipment as a cost saving. Project timeline I've mentioned, plant commissioned in January 2024, steady state in January 2027, and a 45-year mine life. Just really quickly, don't have much time left here, but just really quickly on Lion Battery Technologies, we are actually very excited about this. We own all the intellectual property at Florida International University, including the patent pending innovations. We're actually putting PGMs in a lithium battery and looking at the cutting edge of lithium batteries, either lithium air or lithium sulfur. And I won't go into the technical details. You can look at this on the website, but it's quite interesting to compare the Tesla Model 3 battery at 371 kilograms for a lithium ion battery with nickel, manganese, and cobalt. If you go to lithium air or lithium sulfur, you have the opportunity for 5 to 10 times the power to weight ratio. And yes, that involves some PGMs, but the amount of PGMs that you use, although it seems significant, it's something like 10 grams in lithium sulfur. If you thrift out the nickel, you actually have the money to afford that in the battery. And imagine a battery at 5 times the power to weight ratio. We're getting results in lithium sulfur that show high cyclability and these kind of power to weight ratios. So it's very exciting, still relatively early days, but there's actually 40 scientists working on this, including 6 postdoctoral fellows, and our next patents are due to be filed here any day. So this is something that we're very excited about, and could end up being quite a value add to the company. Finally, our capital structure, we have 62 million shares outstanding. We do have some debt, so we have a $20 million credit facility with Sprott Lending. We do have the option to extend that into 2022. And we've got a 6 7/8 convertible note. Pricing on that's way up at about $10, so it's not relevant from an equity perspective. Also due in mid-2022. So these will have to be dealt with, but we think that with the project timing we have now, we can deal with this well after our construction decision. And we certainly have been through the toughest part of the platinum market and our challenges previously. We've got some great supportive shareholders that stuck with us, and some new shareholders as well, including Hoskin Consolidated. So our market capitalization is a derisory $80 million against an absolutely world-class asset. So our near-term milestone is the mining right. Then 90 calendar days later, the Impala option exercise and a construction decision, and the start of construction through 2021, where we see a drastic change in the view of the company. This mine, very clearly, it's in our 43-101, has the potential to be one of the largest and lowest cost PGM mines in the world, at a great time for palladium moving forward. And I'll stop there and look for questions.
Sure, that's great, Mike. Thanks. Maybe just something that's been very topical with on all our webinars recently. Perhaps talk a little bit about how COVID-19 is impacting Platinum Group's operations, and obviously this early works program that Impala is funding.
Yeah, that's a good question. I mean, we've been very busy with the last few days. We were on a conference call until after midnight last night with the Impala team, so we're very much moving forward. You know, they've commented that, look, under these conditions, this is work we can actually do. We have a team of engineers assigned. We kicked off the project. Impala's agreed to pay for it, and all the detailed engineering is underway. So it is work that can be done, and obviously physical work, including geotechnical drilling, that'll have to wait till after the lockdown, but all the engineering work is full steam ahead. And in terms of the permit, we were right up to the final stages of that before the lockdown. So we'd actually had a call for our environmental bond for the mining right. And that normally only happens right at the end of the process. So we've completed 135 public meetings. We've filed 80,000 pages of documents. We're right at the point where that can come. And it's gone very well. So I think, this is great that Impala has made it a priority. They're of course quite busy. I mean, they have 40,000 employees to worry about in multiple operations and a smelter and global customers as one of the top 3 PGM producers in the world. And notwithstanding all of that, they were on a conference call with us at 1 in the morning to make sure that this project's marching ahead with our technical committee. So it's definitely a priority and it's happening.
Right. And that's a very good sign. You're better connected in South Africa than most on this call, including myself. Maybe talk a little bit about the 21-day shutdown. Are you hearing anything of whether that's going to be extended or it's just going to be the 21 days?
I'm reluctant to answer that question because the president is due to speak right now, actually. So there may be updated news that the listeners already have, but the short answer is I don't know. I think the general consensus though is, and there's press around this, that mining is being looked at as a pretty essential service in South Africa, that it's a major part of the economy, it's a major part of the export economy, and the social network that we have and the luxury we have to work from home here at a senior level, that just doesn't exist for the majority of workers. And so I think there is a pretty strong effort to get back to work and mitigate as much as possible. And, that's what I expect to see. North American Plating, by the way, just as a comparison, was deemed an essential service in Ontario, and they are continuing to work today.
Yeah, there's been Ontario mines have generally been operating in varying states of full readiness. I guess maybe we'll stick to that shutdown and maybe go a little bit on the palladium market. Obviously, South Africa is crucial to the PGM market. 40% of palladium, 75% of platinum.
Yeah.
But a lot of that comes out of some very old, deep mines. At the end of this 21-day shutdown, from your experience, how does this look to ramp back up to full production? Is this something that is this something that's going to be a short process or sort of a long process to fill that demand?
So once again, there's multiple views on this. We were on with one of the senior global banks platinum analysts this morning on a conference call, and he was quite optimistic that production could come back. From my practical experience, having been in conventional and narrow stopes, there's quite a lot of work that has to be done to make safe. I mean, even after a couple of days of being out of a panel, you need that panel geotechnically checked, and you need quite a bit of work to make sure that it's safe. And I think that the protocols around actually getting back to work are going to require some work. So my personal view is this is going to take a while from a practical production ramp up point of view. I know that there's a very strong desire both by the department, by the unions, and by the CEOs to get to work. But having said that, I think there's a lot of work. So I think the production profile will be relatively slow. And I think there's a bunch of things that come out of this. It's a very different profile to work with 1,000 employees on a site to produce 400,000 ounces than to work on a site to produce 600,000 ounces with 20,000 employees. And the health and safety aspects of that are drastically different. And so I think that the mechanized operation just gets another highlight of its natural advantages.
Right. Breaking news from one of the viewers. Apparently, South Africa has extended the lockdown by another 2 weeks, so it will continue to the end of April.
I anticipated such. So, yeah.
A question from one of our viewers on the ownership structure. Once Impala exercises their right, will Platinum Group Metals ownership ever drop below that 33% mark? I believe it's 32 and a bit, but
well, ever, of course, is a very long time. So, theoretically, it could go to zero if we were bought out. So, but no, I understand the nature of the question. I think, we will have to participate. So we will, in all likelihood, have an equity call, and we'd have to participate pro rata. And as I said, at a 50-50 debt equity ratio on the feasibility study cost, if you take Impala's initial contribution of 130 million out, you end up with about a $60 million equity call our end. So we would have to raise that money, and we'd be responsible for that equity. What's interesting, though, is that call would come after Impala spent $130 million building it. So, I'm quite looking forward to like having my cup of tea and watching them build $130 million worth of mine construction before we have to go to the capital markets for that kind of money. So, I think, and just to be clear, our management and board and shareholders are 100% aligned that, it's all about the math. We definitely don't have what I describe as teddy bear syndrome about this asset. Like this is my teddy bear and nobody can have it. It's all about the math. There's zero emotion around whether we contribute our pro rata equity and stay around for 45 years and collect the dividends, or we pass it on to a majority owner. It's really just mathematical. So
yeah. I think that's a good way to put it. Next question comes with respect to sort of the balance sheet, where you guys are at right now. I guess you guys just filed financials last night, and then what the burn is, what your burn is right now, especially with Impala funding the work.
Yeah, so our burn is pretty low. We've got G&A in Canada, which we've worked hard to chop down, shrunk our office, shrunk staff, all that sort of thing. So our recent published financials, we had just over $2.5 million in cash and about a $400,000 receivable. So we're in pretty good shape, and Impala's picked up the majority of our costs, in fact. So we're in a decent position. We certainly feel strong through our mining right grant, and probably right through Impala's election, which means that we can see all of that without doing anything financially. But if we did do something, it would be very modest, because with the support of our largest shareholders, because we just don't need a lot of money right now.
Right. Yeah, I guess with this much news on the horizon, it's patience is the right approach.
Absolutely, and we can do it with confidence, because HCI is a strong fund, and our scale of capital needs is very small in their business. I mean, between Franklin and HCI, you're looking at well over $1.5 billion worth of assets under admin. So it's not something we sweat. And Johnny Copeland, who's the CEO of HCI, is on our board and is very, very up to date as of yesterday.
As far as maybe focusing a little more on the project, with respect to Waterberg, obviously a lot of work went into producing the definitive feasibility study. What are some of the optimizations that aren't included in the definitive feasibility study that, say, someone like Impala, once they're in control of the project, assuming that they exercise their right, would sort of look at as opportunities to drive the thing ahead?
Yeah, so we're looking at those in the work program we're doing now. So there's both opportunities and risk mitigation. So you have to respect them. They own several mines. They've built several mines successfully. They have tens of thousands of employees. They have a very large engineering team that runs mines regularly. Interestingly, we were very happy that they picked this project as a partner, because they have the mechanized experience, although not in long hole large stopes, other than buying North American Palladium, where they've now acquired that expertise. But for example, in Zimbabwe, they mine a 2.5 to 3 meter mechanized seam, and they did all that with decline development. So all of those attributes they're very familiar with. So the key opportunities are really around, number one, the decline sinking rate. So if you could bring in, for example, we budgeted it on basically South African rates, achievable rates in South Africa. If you brought in a contractor with very good experience and had world rates of sinking those declines, it would accelerate the initial development. So that's one area. And then the upper 3 levels of the mine, they're looking very closely at and looking at actual simulations with pieces of equipment. So there's a computer simulation you can run with every truck, every driver, every scoop, every drill rig, every hole, and you run time and motion studies of all of those working together. And that, how that is actually put into the final design is a key part of that first 3 years ramp up. So that's another opportunity for optimization. And on risk mitigation, it's really down to the geotechnical design of those decline positions. Are they in exactly the right place? Are there places you want to move them to increase that decline sinking rate? And then also on the water side, that's another area they want to look at closely. We have way more water than we need, but in terms of even further comfort in that and how it's connected when, that's also part of the work that they're doing. But they're all normal steps anyone would do pre-operational readiness.
Okay.
Big one would be a tunnel boring machine. That's one of the things that's actually formally in the list, is tunnel boring the initial declines. And that has to be traded off capital versus time. But those things can go at 300 meters a month, and we've based the feasibility study on 35 meters a month to start, moving up to 75 meters a month. So that could change project profile.
In a hurry,
Yeah,
for sure. I know, I believe at Stillwater they use tunnel boring machines pretty extensively.
absolutely. And Northam actually just used one, although they just stopped using it, and we're working to find out why. We have a very good relationship there, so we'll find out why they've stopped. It may be just a capital deferral rather than a technical reason, but that'll be an interesting case in point.
Okay. And I think I think you talked a little bit about this in the presentation, but as far as development assets go, and where based on your working with Implats and your experience, where do you think Waterberg fits in their sort of development timeline and how they're approaching things?
So it's in their chart, right? It's in their annual report that this would be the lowest cost mine in their portfolio, and that's in a feasibility study that they approved.
Right.
So that's pretty clear. In terms of productivities, it would be the most productive mine that they have on the employee side. Interestingly, in an environment where you see continual labor escalation, this gets more and more poignant. So one of the things we did with Fraser and McGill, the independent engineers, post the feasibility study, is we actually analyzed that mathematically. You sort of know it intuitively. In a conventional mine, labor is about 60% of your cost because of that 1 meter thickness. At Waterberg, labor is 22% of your cost. So, if you escalate labor even at 4% over South African standard escalation, you're going to be in trouble, because that's a very rapid escalation, 4% compounded. So we looked at that and what happens to the conventional situation. And what we see going forward is that the logical escalation of labor costs, even with a 20% up basket price, is going to create issues in 2030 or so. And so we see actually quite a drastic fall off of conventional PGM production as we move forward in the next 5 to 10 years. And we've mathematically modeled that actually with the S&P Global Database, 75,000 data points, and we built a financial model for every single mine in Southern Africa to know this. And it just highlights the strategic position that we're in, is that those productivities of 30 ounces per employee per month, it really bites 5 years from now. And I think that trend is going to continue, and I think that position in the portfolio is important. And the other thing I mentioned is it's directly in the materials about the purchase of North American Palladium. So Impala spent $750 million in cash to buy North American Palladium, and one of the things that they got was the skill set to be able to bulk long hole mine. And the mining method of North American Palladium is exactly the mining method you're going to use at Waterberg. So that skill set is directly transferable, and it was one of the motivations that went to Impala's board. So, I think it's part of the modernization of the company. And, interestingly, they changed their byline. Their byline under the company name was distinctly platinum, and they changed it to excellence in PGMs. So that tells you a difference in emphasis from platinum to PGMs in general, which of course is the focus around palladium.
Right. Well, the $400 million a year in free cash flow that they're generating at $2,000 palladium also helps for the North American.
That would you think get the board's attention.
And the fact that they're now able to it could easily fund the construction of Waterberg out of that cash flow.
Yeah, and the CEO of Impala, people have seen this, has been pretty cautious, right? I mean, they're a big company. They commit to construction when they commit to construction. They don't lead that a lot. But somebody in Mining MX asked the CEO of Impala, look, now that you've bought North American Palladium, you don't need Waterberg. And he said, no. In fact, if anything, the cash flow from North American Palladium can build Waterberg. So that's in the public domain.
Yeah, another interesting comment from him at their annual meeting or their quarterly update in February. One of the analysts, South African analyst, asked him about putting more capital into their traditional operation or conventional operations ahead of because now they were profitable at $2,000 palladium, and he basically said the plan for those conventional operations, despite the price rise, has not changed. And that really echoes some of the work that you've done, and why I agree with you that Waterberg is going to be at the front of the list simply because of all the advantages that it has over the existing assets for the most part.
Yeah, and it's interesting around discussion around risk, right? Because people say, well, an established operation versus a greenfield operation, which Waterberg is, has a different risk profile. But it's kind of the devil that you know versus the devil that you don't. I mean, and what I mean by that is, in the existing operation, if you have a 20% margin and a 4% escalation against your labor, that that's going to be very difficult, and where that's going. In Waterberg, you've got more than 100% margin. The basket price is sitting more than twice your operating costs. Sure, there's some capital and timing risks, but on a 45-year life mine where your revenue is twice your basket cost, I mean, that's a very different profile than something that happens to be sitting at 20% with labor wanting to move up.
Right. Yeah, absolutely. Our next question from the viewers is with respect to the palladium market, and the question is, how much of existing inventories exist that can be drawn down on in palladium? And I'll let you handle that one.
Yeah, that's a great question. Thanks for asking it. From a producer inventory point of view, the general consensus was going into the shutdown in South Africa that there wasn't a lot. We did hear from a South African analyst this morning saying that Impala had some. I don't have direct visibility on that. But certainly there is pipeline. There's always pipeline, both from concentrate sitting at the mouth of the smelter to through the base metal and precious metals refinery, and then even out into the market with the auto business itself. So there's certainly pipeline inventory that can be drawn over a matter of a month or two. Beyond that, from what I know of, and I've walked around the sheds where the concentrate is in a smelter, so kind of like got an idea of how much that is. Beyond a couple of months, things get pretty tight. And I know, talking to Norilsk directly a couple of weeks ago, they sell what they make. So Norilsk itself, from the Russian side, doesn't hold a big inventory of palladium that they can feel the market with here. They sell what they make. They told us that directly a couple of months ago, month and a half ago. And so the big boogeyman has always been the Russian state stockpile of palladium. And given the run in the palladium price and the challenges with the oil price and the Russian state situation, it would be pretty surprising if there was a very large state stockpile left. And in fact, the owners of Norilsk set up a fund to buy a block from the state stockpile to act as an organized buffer through shortness of supply. And in fact, just before COVID really hit, that fund announced a 3-ton sale into the market when palladium was at $2,500 to try and cool the market off. It was quite fascinating what happened there. If you do the math on it, it's like 96,000 ounces and nobody cared. So, even when they tried to pour cold water on the palladium market, it just drove right through it. So, everything that we know from studying the market for a long time is the inventory position is pretty thin. On the flip side of that, though, of course, is the demand's gone to almost zero. So, the shutdown of the auto business backflowed into palladium demand like immediately. So it all depends on what the shape of the recovery curve looks like. It's more about that, I think, than what the inventories are.
Yeah. I mean, palladium, kind of said, palladium was very tight before the shutdown, right? There wasn't a lot. I think forecasts are around 1 million ounce deficit for 2020 was the general number in an 11 or 12 million ounce market. So your inventories have gone down. The other part of that is the ETF, the physical ETF have been being redeemed to get the metal out of it. So there isn't a ton of surface. A ton is probably an overstate, but there's a lot of inventory sitting out there for.
Well, that story is amazing, right? I mean, we went from 3.5 million ounces of palladium in the ETF to 350,000. And during that time period, the Hong Kong import statistics show metal going physical into Hong Kong. So it went to cars and went goodbye. So one of the biggest palladium mines in the world was actually the ETF, which at 350,000 ounces, that bottom part gets very sticky. So I think it's going to be very interesting. I mean, if we ever get a flow into the ETF, you could see a very extreme market.
Yeah. And then the last question is kind of interesting, and this is a little bit further out as the EV market grows. But obviously right now palladium's about 75% of the consumed by catalytic converters. Once EVs take over, where do you see that palladium consumption going? If you're looking at much longer term.
Great question, and I'm glad it was asked. So the big question is, first question is what's an EV? So a lot of EV stats include hybrids. And hybrids are quite interesting because they have a small gasoline engine which requires palladium. So in fact, they use a lot of palladium. We love hybrids because the loadings have to be higher because that engine cold starts and stops all the time. And it still has to make the emission standards, and the catalyst doesn't work very well. So we love hybrids. So if EVs count hybrids, we love it, and the palladium market gets even tighter. If it's EVs that's pure battery electric vehicles, they don't use palladium. So, in the long term, if you see, massive adoption of EVs to the point where they actually mean that internal combustion engine numbers go down. Now, the reason I specified that is quite important because the car market is somewhere in the order of 100 million cars a year. So if you have a 3% compounding growth of cars, that's 3 million cars a year growing. So the EV market has to get to a very big percentage from where it is now to even stay even, because the growth of 3% on 100 million regular vehicles is a lot of cars, and we're nowhere near that level. But far in the future, yes, which is precisely why putting palladium in a lithium battery is really interesting. So you immediately take what's a strategic threat to that market and turn it into a use. And, the criticism you get about that very commonly is, well, hold on a second, palladium's too expensive. So there's 2 points about that just quickly. One is that for every internal combustion engine you take off the road, you free up 5 grams of palladium. So if I need 10 grams of palladium for my battery, I only need 5 grams new because I've taken it out of the car that's not internal combustion, first of all. And second of all is you can afford it. that actually, if the EV solution is there with PGMs in it, you can definitely afford it. So there's a lot of push behind that solution for the 10 years out and beyond. And I do think the other thing is, of course, with the price of oil, where it is, internal combustion engines are going to be happy for quite a while.
Right.
So this is definitely a 10-year plus, 15-year plus question, I think. But it's a valid question, and it's precisely why Anglo and ourselves are so keen on our battery.
Right. I think with that, I think we'll wrap it up here. I'd like to thank everybody for joining us today. I really enjoyed this conversation, Mike, and the presentation.
Thank you.
Look forward to next week. Our next webinar from Red Cloud is on Tuesday, talking about the gold market with Trey Reich. So please register and tune in for that. And we look forward to seeing you then. Thank you very much, everyone.
Thank you. Thanks, everybody. Thanks for attending.